All right, let's do a trade plan in OII. I thought I'd use this to do a lesson on, what is an expanded swing, right? It's part of market structure. And not just, to define it, but we'll also look and try to understand it a little bit. And so quite simply, in a market, we're going to need some objective definitions to understand this, but something that's simple. But the first thing to learn, and I did a earlier session on market structure and swings, this builds on that. So think of an impulse leg, right, as something giving the direction, the intention, and then the reaction leg is the pullback, the reaction to that impulse, reaction. And same on the way up. Impulse, reaction, impulse, reaction. So when we look at a swing, we can see that it has a process, and we can look at it in different pieces, right? Impulse, reaction, impulse, reaction. And then we can also see there's little swings within big swings. So we'll make a distinction of major and minor because they both have the same definitions. A new low will tell us that there's a swing. That's my definition. And this is a little swing, and it's going to have a minor reaction leg and a minor impulse leg. Just like this big swing is going to have a major reaction leg and a major impulse leg. So we're getting a little more sophisticated in how we're seeing and understanding. So now that we know what the reaction leg is, an expanded reaction leg is simply just, you can take the size of that reaction leg and go backwards. Is it bigger than that one? Is it bigger than that one? Yes. So it's expanding the prior swing. That's what an expanding swing is doing. It's expanding the prior swing, and that's what we can do quite simply. But we're also going to understand it. Plus, we want to be able to take these definitions and be able to put them here on what looks like chaos. You can see how I've already mapped a market, and it fits my definitions, and it fits the model. And so I'm structuring the market: major swing, minor swings, minor swing. And they fit a swing, right? Reaction, impulse, reaction, impulse, reaction, impulse. Reaction, impulse, reaction. So this would be the major. See, green and green, green and green, orange and orange, orange and orange. So that's structuring the market, right? So we can now see it in waves. My two setups are basically one's for contraction and one's for expansion. And so you can see the market's doing a contraction here. You can see the market is contracting, right? It's getting squished. It's just sloped. And then boom, expand. Now, expansions are nice because what's happening is, you have the status quo of the market going in a direction. It just keeps going. Not only is it going in a direction, if you take a look, it's going in a direction doing the same size reaction legs, give or take. It's very organized. It's very pushy. It's very organized. This whole structure here is very distinct within the rest of the structure. And so it's contracting and then expansion. And we like expansion. So expansion is a change in behavior, and it's throwing a lot of people off balance at the same time. So let's spend a little time and understand what's going on besides just the definitions, because this can be a bit dry, but there's supply and demand things going on here. So put yourself in these people's shoes, okay? So let's say you turned around and you shorted a market. Let's say you shorted this guy here. Let's say you shorted it. Maybe you shorted it here. Maybe you shorted it here. Maybe you shorted it and you had it in the money. Same thing. If you come over here, maybe, okay, good. You got short. And then, all right, you got short. So think about everybody who's short here, here, even here. Look at that bar, right? Think about everybody who's short all along here. And why are they short? Well, the market's just cruising down. And what happens when the market starts to pull back? Starts to pull back, they say, oh, big deal. That's what the market's doing. I'm short. I'm in the money. I'm just going to keep going with it. You see, I got a tail, and then, all right, no big deal. And we can even measure, the distance. All right, it seems to be just going short about there, about there, about there. Now, what happens if you're short and the market starts to all of a sudden see the tail, and now the hard up bar all of a sudden starts to march up? What are you doing with your shorts? You're starting to freak out. So different people, their indicators now are starting to turn. Why? Because the market's starting to march. And if you're short, you're starting to freak out a little bit because you're losing profits, right? And it keeps going and it's driving. Now remember, the impulse is down. You don't know if it's a pullback. You don't know if it's going to turn around. That's the problem. Nobody knows. Everybody was happy when it was just cruising down, but now we're not all happy anymore. And there's confusion and there's opportunity in confusion. So just thinking of this from a trader's perspective, not only are the shorts confused, there are people seeing this and their indicators are turning and they want to be long, especially if maybe they're looking at more data, right? And they're saying, oh, look, I can get on this big swing and it's taking off and I can hop on. So now you got the longs are kind of confirming themselves here and they're jumping on because it's going up. And then, this is some of the confusion that happens if you don't know what frame you're trading and you're just mixing a lot of different time frames up and you're not sure how you're using them in a structured way, and it gets a lot of confusion. So you got the confusion of the shorts, you got the confusion of the longs who are hopping on, and then all of a sudden, wham, right? The shorts got stopped out, the longs are getting stopped out, the book's getting cleaned. And so that's a little bit about what happens in an expanding leg. It offers opportunity. A lot of confused traders jumping back and forth because the status quo has changed. The contraction. All right. As humans, we don't like change. When something changes, that happens. And so you can think of it quite simply as they're all happy. Everybody's squeezing their shorts and making money, making money. And then it gets to a level where, uh-oh, and it also the longs are like, maybe I can hop on. And right, there's this transitional point it's thinking about. And we don't know what it's going to do, but we can follow it. I wait for a lot of confusion to happen and enter a trade. And we can map a market, and you can see this in any frame, right? This is all just market structure. Further before we were talking about how each one of these has a shelf. I mean, you can see a swing has a shelf to it, and price will interact with those back and forth. It's just supply and demand. And we're just locating, where buyers and sellers are making their stand. And all this is just market structure and tools. Make a distinction between market structure and trading structure. Next, we have to do some things, not in an abstract. We have to literally define our risk. We have to work with our risk, and that's our trading structure. So we can map a market, and you can see this dynamic in any market, anywhere. I could take this, let's take this and put this on, say, a monthly. So if we take this to a monthly, And we did a little bit of mapping. You can see the same thing going down. I see my big swing, and then you can see them, right? They're getting squishy here. And now the people who were short are starting to freak out a little bit, and then some people are hopping on the longs. And you want to have a plan when you're doing this, but it's the same kind of action that you'll see in any market in any time frame. We just want to have an understanding about how price moves. All right. And that's pretty normal, something like this. And you'll notice, my other definition is relative swings. So you can see the market. This leg's about that big. Notice the other leg is about that big. And so these two are related to each other. This leg is about that big. And see, these guys are all related to each other. And then it finally changes that direction. Right? It finally changes that direction. And, simple line tools also help us see things, what's going on. All right, so that's an expanded swing, and it's a change in behavior that throws a lot of people off. We just want to understand it so that we can design things around it. Now, let's do we did some market structure with swings. So you can see when you map a swing, it's not that hard to read this market. If I'm doing analysis on this market, I'm saying we made a downswing. We pulled back about the same length. We started down, and now we're still working our way to go down. We don't know what happens. Nobody does. All right. Now let's structure our trading. So I know what swing I'm trading. And if I'm doing any measurements, I know, for instance, what swing I am measuring. That guy. Right? I don't have any doubt about it. Whether it's fibs or whatever, I know what swing. If I'm trading the little swings, I'm trading the little swings. Right now I'm trading this big swing for a continuation. So I'm just going to use our little fib tool here just to give us some lines and help us make a plan. So let's get rid of this so we can put our plan over here. And I know exactly where I'm going to enter. 2054. And I'm going to mark it down. $20.54. Right now I'm structuring myself, my trading. I know exactly where I'm going to put a stop. 21.47. I know exactly my position size. I'm risking, what, 0.5% of my account. And so all I need to do is take that distance and divide it by the half. And part of my routine is just entering it into my spreadsheet. And that'll also give me the shares. And these are our open orders. And this is part of the documentation, part of the trading plan. So this is going to be OII. I don't know what happened to my fonts. And we know we're going to enter short at 20.54. And we know we're going to put a stop at 21.47. And that's going to calculate some shares for us. 538. We know we're going to shoot for 6-1. It's going to give us points risked, target points, and we just finish filling out the plan. And then we'll double check everything. So shares, 538. Target, it's going to be 14.96. All right, let's get our risk reward tool up here for a short position. So I'm going to have a limit order waiting, and it's going to go at the same time with a stop order and a bracket order and a target order. Looks way down there, don't it? Okay. And then we can just create a limit order out of this and double check everything. So we're going to sell limit at 21.47. And stop's going to be 21.47. And target's going to be 14.96. And it's going to be a $500 risk. And let's see, did it spit out the right amount of shares for us? All right, so 2047, 2147, 500. So it's spitting out 500. So let's double check that. Oh, that's why I fat fingered it. It's a 21. No, that's 2054. Do two things at once and get confused, especially from chewing bubble gum. All right, $500 risk, 537. Okay, things are matching up now. We double check our numbers. Our stop is 47. Okay, let's send this guy off. Now, parameters for this particular trade, let's put, and these lines are just risk reward lines. There's nothing special about this line. So the parameters for this trade are, I'm either going to get stopped, all right, or it's going to enter and start to go. If price hits the 75% line before my entry, I'm going to cancel the trade. So that's the rules, right? So your setup's going to have rules just right along with everything else you got. So that's what it looks like to, number one, read an expansion and then actually play an expansion. So I'm playing this expansion using the contraction afterwards to bounce me in. That makes sense to you. So I've not only spotted a contraction on my chart, I have a method for an expansion. I have a method for trading it. And I'm going to put exact parameters, and that's going to be my trading structure. All right, so that's it. The expanding swing, actions and reactions.